Good afternoon, financial professionals. Abby Fletcher here of E4 Insurance Services, welcoming you to The Brew, building relationships every week. Thanks for tuning in today. For those of you joining The Brew for the first time, we like to start the Brewcast by celebrating today's National Day for January 13th. Today is National Rubber Ducky Day. According to 1973 Sesame Street calendar, Rubber Ducky's birthday is January 13th, making today National Rubber Ducky Day. The earliest patent dates back to 1928, but fast forward to World War I and II, rubber was a valuable commodity. Rationing became mandatory, and by the 1940s, with the advent of plastic, the rubber ducky was fitted with this new model. Many of you probably know the song that Bert and Ernie would sing to their beloved rubber ducky. Today, feel free to sing that one loud and proud. Today on The Brew, as part of our practice management series, we have E4's very own John Florance, who serves as Senior Vice President of Annuities. Today, John will lead the conversation on helping clients who are experiencing life transitions, focused on divorcing couples. Take a look at the chat box below. You'll see the documents that pair with John's presentation, and I'll also be keeping a lookout for questions. Also, all attendees are in a drawing for a prize, so stay tuned and we'll be announcing the winner shortly. Thank you for tuning in, and without further ado, John, welcome. The mic is yours.
Thank you so much, Abby, and Rubber Ducky, you're the one. One of my favorite songs of childhood. On a less happy subject, we get to talk a little bit about divorce today. And as Abby said, this is part of the series that we've been doing. The series of presentations is really 4 parts. We began, I believe, in November, December with the first one, which was Understanding Grief. We'll touch on that just a second. The second presentation is today, and this is about divorce as one of the key life transitions that clients go through. And then we'll also be following up in the weeks ahead with one related to death, and then another one related to disability and illness. And so that'll then complete the series of 4 separate presentations really about advising through times of client transition. So today we're going to focus a little bit on divorce. Before we get to that, I think we need to advance my slide here. Just remind you what we discussed the last time when we were kicking off this series. And it was a little bit about understanding grief and how life events trigger grief in our clients. So life events could be any number of different things, both positive and negative. They tend to be more negative events, but the negative events that happen then create a sense of personal loss that our clients go through. And that loss leads them to respond with both physical and emotional responses. A lot of times, those emotional responses trigger financial behaviors. As an example that I teased with the last time, we became empty nesters a couple of years ago, and my children went off to college. And, with all of that extra time, my wife and I started thinking, that we were going through a sense of personal loss and not having our children around. And with all that extra time and extra money that we had as well, we said, hey, we should go out and buy a yacht. We actually seriously contemplated that for a period of time. Well, that's kind of what I mean, is that when clients are going through this in a more serious and a more deep way, the things that are happening in their lives trigger financial behaviors and impact, which is why it's important that as advisors, you recognize those trigger events and those life events to be able to help your clients navigate through those specific instances in their lives. So the other reason why we're talking about this is that the real impact that this has on your business, both today and in the long term. Statistics have been shown that 70% of new investments and referrals, or what we refer to as money in motion, happens during times of client transition in their lives. And if you think about that, and when you bring in a new client into your practice, or when money is going out, it's usually triggered by some type of large client transition event in their life. The truth is you can actually take a look and examine the dollar amounts that are related to that. And it's been calculated that about 12% of your practices, assets under management at any given time are at risk due to what I call the big three client transitional events: death, divorce, and disability. So today we're going to focus a little bit on divorce. So let's jump into this quickly and we'll get to the meat of it. So first thing is this, is that marriage is about love, but divorce is about money. And it's very, very easy. People, when they feel really wonderful about getting into relationships together, it's all about how much they love each other and how they want to spend life together. But the second things go awry, things kind of get a little bit hairy. And divorce is always about how we're ultimately going to split up the money and the assets. And thereby, because you are their financial advisor, a lot of that can come down to you, and you can be a great service provider to them and being able to help them navigate the pitfalls that accompany divorce. Let's briefly touch on some of the statistics related to divorce. So first of all, it's a little bit squirrely to get your hands around the actual number here, but it's been estimated that the lifelong probability for divorce in this country is right around 40 to 50% of all marriages ending in divorce. Now, that's hard to really estimate because sometimes they end early, sometimes they end late. There's a lot of question about what constitutes a marriage relationship. There are people that are in basically, common law relationships or partnerships that aren't technically marriage. So it's really difficult to land on these numbers. But what we do know is that generally speaking, since the 1960s and 70s, divorce has actually decreased from what it was, but we're still somewhere around 40 to 50%. I think maybe not surprising are some of the other statistics that about 67, almost 70% of second marriages end in divorce as well. And then the third marriages, divorce rate is typically about 75%. I guess maybe what that suggests is that if you haven't figured out your problems from your first marriage, it's very unlikely that you've figured them out in your second or third ones, and you maybe carry some of that same baggage with you moving forward. The issue, of course, is that the cost of divorcing for your clients is pretty high. The number that is given for the average cost is about $15,000. And anybody who's been through it knows that it's probably substantially higher than that, but it really depends. Those averages are drawn down because you have a lot of couples that get married early on in life before there are assets to be divided, before there's really any complexity to the relationship. And those marriages and those divorces tend to cost less. But the older that your couple gets, the more established, the more involved they are in the relationship, the more assets that they've accumulated over time, the more costly that those divorces become. So keep that in mind. The other statistic really that's important to recognize is the prevalence and the continued emergence of gray divorce. What we mean by gray divorce is divorce for people who are over the age of 50, and where the general divorce statistics have been declining over the past few decades, the incidence of gray divorce has actually increased by a factor of 2 to 3 times since 1990. Gray divorce tends to be worse off for women than men. It's been proven that, that women who end up going through divorce at a later time in life frequently get pushed into poverty because of circumstances of them, not being able to find work or maybe never having worked before in the first place. So there's issues there. Healthcare is also a major concern for those people. And I think it's important that as you're talking with those clients who are maybe discussing this as a possibility in their lives, that they understand what individual expenses might be for them in a divorce situation, and helping them to understand what their balance sheets look like as a separate individual as opposed to as a couple. So those are some of the areas related to gray divorce, and something that I think for you in your practices represents probably the bigger risk as well. The longer your clients have been together, the more assets they've accumulated, the more likely that that split is going to involve major dollars moving away from the practice at some level. One of the things that I think is critical from a financial advice perspective is knowing the rules of how divorce impact you and your ability to work as an advisor to your clients. And those rules take place really in 3 different levels. There's individual state rules related to divorce. There's rules pertaining to your broker dealer that you're involved with, and also rules related to your professional designation. When I've done this presentation in live audiences, I ask people to raise their hand if they're CFPs. So all the CFPs in in this presentation, please raise your hand. Okay, I don't see you, but I'm going to assume somebody's raising their hand. So my question to you is as a CFP, what is your role in relation to working with a couple that is divorcing? Are you allowed to be an advisor to both of the parties? And I can't hear your answer, but the answer is, if you know your CFP material really well, that ethically you can really only serve one of those clients fairly, that there is an implicit conflict of interest when you're trying to represent both parties in a divorce. So that would have implications in terms of whether or not you can serve both the husband and the wife or both partners that are going through a split. The same thing applies to broker-dealers. There are some broker-dealers that do not actually allow you to work as an advisor to both of those clients, and that you would need to assign one or the other of the parties to a different advisor, at least during the period of divorce before the divorce gets settled. So the main thing here is know the rules that apply to you in the state where you live and practice. Secondly, to your broker-dealer, if there are any specific rules to you. And then secondly, your professional designation, if you have any, what the ethics require of you. And then lastly, your personal sense of ethics and morals. You know, what makes sense based on what you know that you can do in terms of helping one or the other of the parties that are going to be splitting up. Let's talk a little bit about what your role is when it comes down to divorce. You find out that somebody's going through this in their lives. It really comes down to three things: listen, communicate, and refer. I think the most important thing is to recognize where your levels of competency are, particularly in the technical subjects that are related to divorce, and knowing when you need to be able to take a client and refer them to another professional who will be able to perhaps give them a better level of service and support than what you might be able to do. So that really relegates your role to two really critical areas: listening and communicating. When I'm talking about listening, it really means that when these people are going through really difficult times in their life, and divorce is one of the most difficult times in their life, that the more that you can kind of hear them out and hear what their concerns are, the better you're going to be able to provide advice to them. Secondly, on the listening side is, please do your best to remain objective. Never take sides, no matter how closely you feel to one person over the other in a relationship. When we talk about the communication side of it, it's really about organizing the information that you can help them to gather, about being simultaneously transparent to both parties. You know, if you've worked with them as a couple, as you pull together and help them pull together the information, that you're communicating with both parties simultaneously in a way that both sides know exactly what's going on. Make sure that you're setting your advice and service expectations with them on the front end. Let them know the things that you can and can't do. And then finally, of course, make sure that you're delivering complete financial packets to both parties. To help you with this process, we've actually developed something that we call the divorce documentation checklist. And this is a template that you could take. It is attached in the chat section of this. You can download the document, and it has a checklist of all of the various types of information that your client is going to want to collect when they're going through a divorce situation. As you can see, the list is really, really extensive. And you may find that one or the other party to a marriage was not really familiar with any of the stuff going on this side of the equation in terms of the maintenance of the day in and day out maintenance of a family. So one person is probably going to have a much heavier lifting job than the other when you're going through the gathering of this information. You can take this checklist, copy it, paste it onto your own letterhead, and have something like this to be something that you could give out to a couple when you know or recognize that they're going to be going through a divorce proceeding. So this is something that could be useful for you. The second, or the last part of what we just talked about was referring out as well. Again, understanding what your role and your limitations are to your client. As I like to say, as you refer out to other professionals in your community, so you shall be referred back to. So knowing what you are good at and letting other people be good at theirs will actually result perhaps in more clients coming to you because they recognize where your skills are. So one of the things that you can do is develop what we call a divorce referral sheet. And we've also provided a template for you on that as well. This is also something you can download from the chat box. that we have here. But what the divorce referral sheet might look like is a list of professionals that you have relationships with, that you know and trust from having worked with them before, that you're comfortable giving those people's contact information out to a couple that are going through divorce. What would be on that list? Well, I've divided it into 3 sections. What I call the essentials, things that are really, really important as they're going through the process. That would be financial divorce specialists, trusted financial advisors if you're not going to be advising both people to the divorce, perhaps family practice, collaborative divorce lawyers, estate and tax attorneys, bankers, accountants, particularly forensic CPAs. If it's a contentious kind of a relationship, we may need to be digging up information financially, and having somebody like a forensic CPA or accountant can be very helpful in that. So those would be the essentials. The next cut or a deeper level to that would be things like marital counselors, realtors, child psychologists or counselors, nannies, babysitters if it's a young family, people to help move, perhaps mediation services. And what I call the deep dive would be caregivers, houses of worship, divorce support groups, etc. So this is a kind of list, again, that you can develop. I would encourage you to put it on your own letterhead for your practice and your business, and have that in a folder ready to share with people as they go through this process. The last piece of this, before we kind of jump into the wrap up here, is understanding that divorce itself the process of it is a very technical and can be very complicated thing. And I think whether or not we become specialists in this area, it's critical that as a financial advisor to your clients that you have a familiarity with at least these 10 concepts. I'm not going to go through all 10 of them right now, but there are things like, what is a quadro? What is a financial affidavit? Are you familiar with how COBRA works? Are you familiar with how Internal Revenue Code Section 72 works as it relates to divorce? What is rehabilitative maintenance? What is property settlement notes? These are the terms that are going to come up time and time again as you're working with divorcing clients. If you're not familiar with them and understand how they apply to your clients, you're putting your clients at a disservice. To help you with that, we've actually just created another sheet that you can also download that gives a very top level description of what each of these things are. You can, on your own time, dig into those and determine, just kind of make sure that your knowledge is brushed up on those specific terms. There are other ones, of course, it goes a lot deeper than that, but at a top level, this is a minimum of what you should be familiar with. The last thing that I'll mention in relation to divorce on this short session is the question as to whether or not you should specialize. As you know, in our industry, there's lots of different designations that you can get. There are 2 particular designations related to divorce. One of them is the CDFA, or what's called the Certified Divorce Financial Analyst. This is issued to you and supported by the Institute for Divorce Financial Analysts. I've included the website there that you can click on that. You can see what the requirements are to be able to obtain that designation. If you're finding that this is a niche that could work for you, as I say, these types of specializations are the things that can help to separate you perhaps from the crowd of other financial advisors that are operating in your community. The second designation is a little bit less stringent, a little bit less challenging to obtain, but maybe would still give you the knowledge that you're looking for, is the Certified Divorce Specialist, or the CDS. That's issued by the National Association of Divorce Professionals and can be accessed information with that designation to the website that's shown on the screen there as well. The CDFA is a higher level of commitment to it, not as quite as difficult as maybe a CFA type of designation, but it would still take you some time, and there are some other prerequisites that are required in order for you to be able to obtain that. The CDS is a much shorter course. It's about a 16-week training, and I believe most of that can be done online. It's a really good primer to kind of give you the knowledge necessary to really be able to specialize in helping your clients through this difficult time in their life without the level of commitment that a CDFA provides. So those are 2 areas that could help you if you thought about specializing in this as a means of separating yourself and creating some distinction in your practice. The last piece of this, and we'll wrap up very quickly here, is what I like to call avoiding awkward. All of these difficult life transitions usually create a situation where many times we're caught unawares and frequently find ourselves saying the wrong thing. And as we all know, words really matter, particularly when we're discussing in conversation with our clients. So imagine a scenario where you're sitting down with clients, you've had a nice financial review, and as they're getting up to leave, one of them says, oh, by the way, Bill and I are getting a divorce. And it just completely bowls you over. If you're anything like me, a lot of times you find yourself flat-footed and not having thought about these kinds of things beforehand. And so you blurt out this whatever comes to mind. The first thing that almost everybody always says whenever they hear anything going wrong in somebody's life is, I'm so sorry. So what you're seeing on the screen here is just really a list of the kinds of things of what you maybe shouldn't say, why you shouldn't say those, and instead what you could say. All of these are covered in a booklet that we can provide for you as well. If you send a request in either to myself or to Abby, or even to just info@e4.insurance, then we can send you the booklet of what's called compassionate communications. And it breaks down for all of the big transitional events in life, the kinds of things to say and not say. Why wouldn't you say, I'm so sorry? Partly because it comes across to the person who's hearing that as being very insincere. It's a knee-gut or a knee-jerk reaction to hearing somebody else's misfortune. And secondly, really because you have nothing to apologize for. It's not you doing something. Maybe a more compassionate way to respond to that would be saying something like, it makes me sad to hear that you're getting a divorce. A lot of times people also think of trying to side with somebody. Imagine you've had a relationship with them and they've shared with you some of the difficulties in the relationship over time. And it might be your inclination to try and say, well, you know, we've been talking about this so long, I'm so happy to hear that that's over with. Well, it's not a great thing to say. Why not? First of all, divorce is never good. It's a very traumatic experience. It throws people into complete disarray. It impacts people on a broad scale that are directly affiliated with your clients.
John's on
not a nice thing
for a moment here.
I'm sorry, we'll pause. Abby, did you say to pause?
Nope, you're back, sir.
Oh, okay, I'm sorry. Okay, so anyway, you can read through those, and if you want the complete list and the desktop reference guide on compassionate communications, just send us a quick email and we'll be happy to send that out to you. So very last slide here is just simply bearing in mind what we do as E4 Insurance Services is we provide a consultative approach to helping you and your clients deal with some of the risks associated with life in the form of life insurance, annuities, and long-term care solutions. How can any of these kinds of solutions help your clients going through divorce? Well, you can see through the slide here, life insurance may actually be mandated by a court settlement in a divorce situation. It can help to provide your clients with supplemental income. It can provide liquidity, help cover future costs of care. Annuities really come into play in divorce by, again, providing supplemental lifetime income for parties that are leaving. It can help to fund a property settlement note. It can help to provide guaranteed alimony, child support, etc., and also protect assets against market financial losses. And long-term care, of course, as we know, helping to cover people's costs of care, prevent forced impoverishment, which is a real big issue concerning great divorce on the female side of the equation. Help to protect your client's estate and create some tax-free leverage. All told, all of these solutions can help to give your clients peace of mind through really, really difficult time in their life. So keep those solutions in mind, reach out to your E4 specialist, and they can help you to design those solutions for your clients who are going through divorce or other difficult times. That's the presentation today. I went a little bit over. My name again is John Florance. I'm running the annuity side of the business at E4, and I'll pause here and see if there are any questions or any comments from any of the participants. Thanks for your time today.
Thanks, John, and totally worth it to go over. Action-packed chat today. And thank you for helping us navigate these transitional conversations. I've opened up the lines for the audience if you have any questions. Also, the documents, gorgeous John, will be connected to the recording of Brew on our Brew blog located on our website. Hearing no questions, let's go right to the giveaway. John, I'm going to have you give me a number between 1 and 12.
Okay, I will say, I was going to say 13, but that's not the number. That's my favorite number. We'll make it, how about 7, lucky 7.
Fabulous. Number 7, number 7. Who's the winner? Ben Nelson. Congratulations, sir. Be on a lookout for a coffee card coming your way from all of us here at E4 Insurance Services. And be sure to tune in next Wednesday for the brew. John will be back for the second part of this series, Advising Through Transition, Death Edition. Thanks, friends. Happy 21 and make it a great day.
Abby, before everybody leaves, I'll just throw it out there as well. If anybody has a couple of minutes to hang out, I will share a quick case study for a case that we just ran through that's directly related to what we were doing. It's kind of extra credit, if you will, so we didn't want to go too long. But if you're still on and you don't have to rush off someplace, take a couple of minutes and I'll walk through an example of how an annuity could actually help through a divorcing situation. So this particular case, what we're calling it is splitting the pension and replacing that with an annuity. We had a husband and wife, again, gray divorce situation, age 58 for the husband and 59 for the wife that were splitting. The husband had, through his employment, earned a pension that was going to pay him about $55,000 a year at age 62. And it's $1 million buyout on that pension. The court order actually ordered that the pension be split 50-50, and we can do that through the Quadro process and have that money not be taxed. So the part of the solution to this case was to take $500,000 of those dollars and roll it into a product that we represent here at E4. That's the National Western Life Impact 8 with the Income Outlook +5 rider. And let me just show you what that actually looked like. So in this example, $500,000 going into the contract for the 59-year-old wife would provide on day one a guaranteed withdrawal payment date of $588,000. Now, she wasn't going to need that income for another couple of years. She was going to continue working. And so we're able to defer income until she's age 62, at which point that withdrawal base goes from 588,000 goes up to 648 and starts guaranteeing her a $32,000 a year income that would come off of that contract for the rest of her life. So try and fast forward her time a little bit. She drives, the income all the way until, in this example, until age 80. At the end of her period of time, she's still pulling that income down. And even though the account value has completely depleted down to zero, there is still both a cash surrender and a death benefit that is available on this contract to help either pay some money in terms of a small legacy to her beneficiaries, or maybe to even help with some final expenses. But this is an example of a court order splitting a pension and being able to create a pension replacement by using a lifetime income annuity on a deferred asset. So that's just a simple example of one of the kinds of solutions that we can help you to structure as you're working with your clients who are going through divorce scenarios. So I'll pause there, and if there are any further questions on the example, happy to address those. Otherwise, we'll see you next time on the brew.
John, I'm glad you did that. This has been a very popular product, so thanks for giving us the snapshot. Any questions from the audience with that additional extra credit that we've taken part in? You might be getting some emails, John.
Yep, no problem. Happy to answer.
Thanks, John.
Thank you. Bye,
Thank
everybody.
you. See you next week.